Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from RNZ on the 15th of January, mortgage calls. When will borrowers see value in long-term rates again? Topic number two from interest.co.nz on the 16th of January. There was a 30% drop in buyer interest on Trade Me property in December. Third topic from Good Returns on the 15th of January, borrowers return to short-term interest rates in droves. Topic number four, interest.co.nz on the 16th of January, economists see latest NZIER quarterly survey of business opinion as clearing the way for a further substantial cut to the official cash rate next month. And topic number five for this week in review from Corelogic on the 16th of January, rumours swirling over New Zealand's foreign buyer ban. $1 million agent thinks changes are afoot. And so first topic for this week in review from RNZ on the 15th of January, mortgage calls. When will borrowers see value in long-term rates again? Households are facing significant decisions regarding their mortgages this year, with interest rates falling and options widening. According to property research firm Corelogic, 80% of borrowers started the year with either a floating mortgage rate or a fixed term of less than 12 months. In contrast, only 10% of new loans were fixed for longer than a year, and that's a sharp drop from 51% last year. The proportion of new loans with floating rates, which tend to be higher, increased from 17% to 28% over the past year. This trend is also reflected in existing loans, where the share of debt on floating interest rates has risen to 14%. That's the highest level since 2020. CoreLogic noted that many borrowers are eager to capitalise on the falling mortgage rates resulting from the Reserve Bank's interest rate cuts. Calvin Davidson, chief property economist at CoreLogic, highlighted that the key issue this year will be whether borrowers will find value in long-term rates again. He suggested that most of the Reserve Bank's anticipated monetary policy easing may already be reflected in current mortgage rates, meaning long-term rates may not decrease much further. David Cunningham, CEO of mortgage broker Squirrel, said that long-term rates could regain popularity if they drop below 5%. Currently, rates are around 5 to 6%, but Cunningham predicted that some rates might fall below 5% in the next 3 months. Despite the rise in floating rates, Cunningham observed that borrowers are willing to accept higher short-term payments for potential long-term savings. However, Michelle Ismonger, a mortgage advisor at Loan Market, cautioned about the risks associated with floating rates, emphasising that while they might benefit from falling interest rates, repayments could increase unexpectedly, making it a gamble. Topic number two from interest.co.nz on the 16th of January. There was a 30% drop in buyer interest on Trade Me property in December. In December, both property asking prices and buyer demand on Trade Me property saw declines. The national average asking price for residential listings dropped by 0.6% from $854,900 in November to $849,550. This also marked a 1.7% decrease compared to December 2023. Several regions experienced price drops compared to November, including Auckland, Bay of Plenty, Hawke's Bay, Manawatu, Whanganui, Nelson, Tasman, West Coast, and Canterbury. Despite these declines, some regions saw modest price increases. Auckland, the country's most expensive region, had an average asking price of $1,047,800, which is down by $20,000 from the previous year. The biggest shift, however, was in buyer interest, with a 30% drop in demand recorded for December. Despite this downturn, Trade Me Properties Customer Director Gavin Lloyd expressed optimism, stating that buyer activity is expected to increase as the year progresses, with many returning to the market to find new homes. My thoughts on this are market activity just about always slows down over the Christmas period as people start thinking about their summer holidays and going shopping for Christmas presents. Market activity generally does pick up after about the second week in January. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and experienced mortgage advisor. And these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3, from good returns on the 15th of January, borrowers turned to short-term mortgage rates in droves. In November, nearly half of the mortgage money borrowed was on floating interest rates, reflecting borrowers' confidence that interest rates will continue to decrease. Residential lending reached $7.6 billion, marking a 1.2% increase from October and a 21.8% rise compared to November 2023. According to the Reserve Bank of New Zealand, RBNZ data, 47.4% of residential lending was taken out at floating interest rates, while lending on fixed rates dropped to 52.6%, which is the lowest since the survey began in April 2021. Borrowers began shifting towards floating and short-term fixed rates after the Reserve Bank began cutting the official cash rate, the OCR, in August. The OCR is currently at 4.25, and economists expect a further reduction of 0.5 to 0.75 when the Reserve Bank reviews it on February the 18th, partly due to improved business confidence. In the central bank's latest figures, new home lending slightly decreased in November with a growing preference for shorter-term loans. Owner-occupier lending on floating or short-term fixed rates surged to 9.34% of new lending, while terms longer than 18 months accounted for just 6.6%. Floating rate loans for owner-occupiers hit a historical high of 45.5%, up from 27% in October. One-year fixed-rate loans decreased to 32.6% of new lending from 41.9% in October. For residential investors, new lending increased in November, with floating rates accounting for 50.8% of this lending, which is an all-time peak. Meanwhile, one-year fixed-rate lending dropped by 13.2% to 31.4%. In commercial property lending, residential property development increased by 7.1%, while commercial property development decreased by 26.6%. Investment property lending rose by 1.6%. Overall, new business lending, excluding agriculture, grew by 34.4% in November, and new consumer lending declined by 3.8%. So my personal thoughts are that if you've got a mortgage rate coming up for refixing in the near future, I would suggest that you talk to your mortgage advisor, get some independent financial advice on that from your mortgage advisor. They can help you make a decision as to which is the best position for you to take over the short to mid to long term. And it costs you nothing. Topic number 4, from interest.co.nz on the 16th of January, economists see the latest NZIER quarterly survey of business opinion as clearing the way for a further substantial cut to the official cash rate next month. The latest NZIER survey, closely watched by both the markets and the Reserve Bank, adds weight to the case for a 50 basis point cut, potentially bringing the OCR down to 3.75%. The results from the QFBO, released on Tuesday, showed a continued easing of inflation pressures, a key factor that economists believe will prompt the Reserve Bank of New Zealand to move forward with additional cuts. Fewer businesses reported rising costs in the last quarter, and the share of companies increasing their prices remained historically low. Kiwibank senior economist Mary Jo Vergara commented that the weak demand environment was reducing capacity pressures, which she noted was beneficial for addressing homegrown inflation. She added that more firms were finding it easier to hire labour, with a lack of sales now being cited as the main constraint on business activity. This softer demand environment was in line with expectations that core inflation would fall below the Reserve Bank's target midpoint in the coming quarters. Vergara and her colleagues, Sabrina Delgado, emphasised that despite the positive outlook, the current economic conditions called for further rate relief. They expected the Reserve Bank to implement a 50 basis point cut in February, followed by smaller 25% reductions in April and May, bringing the OCR down to 3.25%. Similarly, ASB senior economist Mark Smith noted that the NZIER survey data indicated annual CPI inflation would fall below 2% in the next few quarters. He added that the capacity and pricing data from the survey supported the view that inflation was easing, giving the RBNZ the room to continue with its rate cuts. ANZ senior economist Miles Workman observed that the Reserve Bank of New Zealand's previous monetary tightening had successfully generated significant spare capacity within the economy, and that helps to dampen inflation pressures. Although activity expectations were rebounding, Workman noted that the recovery was not strong enough to derail the Reserve Bank's current path of rate cuts. He added that the rebound in activity from such a weak base was unlikely to push the economy into overheating territory, and that there was little in the data to suggest that the Reserve Bank's policy stance was off track. The lift in business confidence observed in the NZIER survey was largely driven by expectations of further rate cuts. Economists agreed that the Reserve Bank must follow through on these expectations to maintain momentum in the recovery. With a potential OCR reduction in February, I'd say it's an expected OCR reduction in February, it was anticipated that the Reserve Bank's accommodative stance would continue to support economic growth while keeping inflation in check. As the country looked ahead to the Reserve Bank's next monetary review in February, many economists remained hopeful that the central bank would maintain its commitment to rate cuts, which they believed would aid in the recovery and help sustain the positive business sentiment revealed in the QSBO. And topic number 5 for this week in review from Corelogic on the 16th January, rumours swirling over New Zealand's foreign buyer ban. Million-dollar agents think changes are afoot. There are increasing signs that New Zealand's government could be considering relaxing the foreign buyer ban for residential properties valued over $5 million. Agents in the high-end real estate market are reporting promising signals, including high-value deals being approved and potential changes to the Active Investor Plus visa program. While the National Party has remained tight-lipped on the issue since abandoning its pre-election pledge to amend the foreign purchase rules, the conversation is gaining momentum within the real estate industry. Speculation has intensified following comments from New Zealand First Leader Winston Peters, who previously suggested that relaxing the ban on ultra-expensive properties could have economic benefits. Despite the lack of any official announcements, agents working in the luxury property market have indicated that more wealthy international buyers would likely benefit the economy. New Zealand Sotheby's International Realty Managing Director Mark Harris highlighted that investments in New Zealand, such as the Active Investor Plus program, could soon allow residential property purchases by foreign buyers without restrictions. If you're investing $15 million in the Active Investor Plus program, an investment in a residential home could contribute towards qualifying, said Harris. He added that there might not be a price threshold if such purchases were incorporated into the program. Agents are hopeful that changes to the visa program could spur more foreign investment, which could benefit the economy by encouraging foreign buyers to contribute to local businesses and infrastructure. Many in the real estate sector see an influx of foreign capital as a positive move that would boost economic activity. Some agents, particularly those working in the prestige market, are advocating for rising the threshold for foreign property purchases to $5 million. Bailey's agent John Greenwood noted an increase in overseas investment office, the OIO applications, particularly those in the $10 million plus range, suggesting that the government is increasingly open to large-scale investments. Greenwood, who's selling multi-million-dollar properties, believes that allowing foreign buyers into the market for properties worth more than $5 million would help stimulate the economy without significantly impacting first-home buyers. He argued that such high-end properties represent a small percentage of overall sales and would not affect the broader housing market. Barfoot and Thompson's prestige agent, Paul Nethausen, who recently attended the luxury property show in Shanghai, agreed. He noted significant demand from Chinese buyers who see New Zealand as an attractive place to invest, especially for those looking to secure a safe and high-quality environment for their families. Nishausen emphasised that foreign buyers not only purchase properties but also contribute to local economies by employing people and engaging in various business ventures. While some economists, like Corelogic's Calvin Davidson, suggest that the impact of foreign buyers is often overstated, there's general agreement that relaxing the foreign buyer ban could contribute to local economies. Davidson pointed out that foreign buyers have always represented a small portion of the market, and that the housing market will likely remain subdued regardless of any potential changes to the rules. While the real estate industry remains hopeful about potential changes to the foreign buyer rules, there's cautious optimism about the broader impact. Many agents and experts agree that the government should consider these changes carefully, weighing the benefits of increased foreign investment against the need to maintain a stable housing market for New Zealand citizens. As the government continues to consider its options, discussions on the future of the foreign buyer ban remain a key topic in the property market. With growing interest from overseas buyers, New Zealand's luxury real estate sector could be on the brink of significant changes, potentially benefiting both the economy and local communities. The coming months may provide more clarity on whether the government will move forward with relaxing the rules for foreign property purchases above $5 million. Time will tell. Ready to seize opportunities in the property market? Join us for our How to Succeed with Property Investing event, available online and in person. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to help you make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, we'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one of our free events and would like to know more about how we can help you get started on your journey now or continue your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website, propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.